Now, imagine we have J countries in the world, and they all use capital and labor to produce capital and labor intensive intermediates. And with the capital intermediates, they will produce only investment, which is one to one. 1 unit of capital turns into 1 unit of the investment good in the future. And also, they will be using both capital and labor goods to produce consumption in a standard Cobb-Douglas form. Now we're just going to normalize the price of consumption as the numerator to 1, and then we're going to leave the price of capital to be equal to the interest rate. Now this interest rate is going to be the world interest rate. It's not going to be specific to each country. The reason why is because Ventura assumes that we have factor price equalization, which basically means that the price of capital and the wages, the price of labor, is the same in every country. This simplifies the analysis a lot. Now, imagine that the average guy just maximizes his future consumption and thus he saves all his wages. When he has to decide what to do with his savings, he has two options: invest into capital and or buy bubbles. Now imagine for a minute that buying bubbles is not possible yet, that the only thing he can do is invest in capital. If he does that, well, he's a young entrepreneur. He has to pay a price to get into production because he has to set up a firm. He buys 1 unit of capital. For every unit of capital he buys, he's able to produce this country-specific productivity next period. So for every unit of capital, he produces pi t plus 1j if he lives in country J in period 1, and he sells this in the next period for this price. Well, then, if you sum up all the investment that is done in country J, which is just going to be I, big I, and you multiply it by the productivity that each unit of this investment has in terms of producing capital in the future, you will be getting the total stock of capital that country J will have in the future. And, we assume that basically, capital depreciates fully in every period, so you cannot, keep track of capital from the past. Now, very importantly, if you buy 1 unit of capital and you pay QT, so basically this is the price of 1 unit of capital, QT, and you put that in the denominator, so this is the cost of getting into the production process. Now, in T plus 1, you will be getting, for each unit of capital, you will be getting pi j T plus 1, and you sell that for QT plus 1, the future price of capital. That means that your future revenue is just going to be QT plus 1 times this productivity term. And if you divide the two, the revenue divided by the cost, you're getting the rate of return of this investment. Basically, if this is going to be given at some level by the economic growth in the world, because these are world common terms. So if the world is growing a lot, this is probably going to be really high. And then if you're a very productive country, then the return of getting into the production of capital is very high, and you would be better off doing so. Now, if you're a country without bubbles, you're going to invest all your wage because these are all the savings you got in investing, but you have to pay each investment unit costs you QT, the price of capital. Now, how much are you going to consume in the future, which is what you care about? That's why you save it all. Well, you're just going to consume the income that you derive from that capital, which is just going to be the interest rate, which is QT plus 1. So you're going to sell that capital and you're going to consume that. You're going to consume the incomes you get from that capital. And finally, as we said before, the rate of return of your economy is going to be some function of the growth rate of the world. I think of this as something that is being determined by the growth rate of the asset prices, but also it's got diminishing returns because the capital has diminishing marginal returns. But this overall rate of return depends linearly on the, how productive you are. Now, what happens if the country has bubbles? Well, think of the bubble as the value of, the stock market. If there is a bubble, the spreads are going to go up by, some rate every year. That means that you can basically, call this the growth rate of bubbles, and that's the rate at which bubbles are going to grow every year. So if you buy one bubble now, you get this mu t plus 1 in the future if you're in country J. Now, you face a decision now, which is, do you want to put your savings into capital, or do you want to put them into bubble? If you put them into capital, you have to pay the cost of investing, which is just the price of capital. And then, if you buy bubbles, you just pay $1 per bubble you buy. And then in the future, you're going to have, your consumption, which is not just going to depend on the returns of the capital. Remember, you invested this amount, and you were able to use this amount to produce all this capital in the future because you were pi productive, and then you sell it in the market by this price, qt plus 1. So this is the amount of cash that you get in the future for producing capital. Now you can also you can also consume a little extra because you bought bubbles. You bought this amount of bubble, and for every bubble you're able to gain this amount.